Sarah, I'm telling you, I've finally installed the ultimate firmware upgrade for my financial brain. I just finished rereading John Bogle's The Little Book of Common Sense Investing, and it's like seeing the code behind the Matrix. Most people are out there playing a high-stakes, glitchy game of beat the market. But Bogle proves that the only winning move is to own the entire system.
Marcus, you and your systems. Look, I respect Bogle. He's the patron saint of the boring portfolio. But let's be real. Bogle wrote this in a different world. He's talking about common sense from an era before high-frequency AI trading, before subreddits could send a dying brick-and-mortar retailer to the moon, and before cryptocurrency became a trillion-dollar asset class. I'm skeptical that buying the haystack still works when the haystack is being burnt down and rebuilt every 5 minutes by algorithms.
That's exactly why it works better now. Bogle's core argument is that successful investing is all about common sense. The system, as you call it, is built on a simple, irrefutable truth. Over the long term, the stock market's returns are driven by the real-world earnings and dividends of businesses. All that sound and fury you're talking about, the meme stocks, the AI-driven volatility, that's just the expectations market. It's noise. Bogle says we should ignore the idiot's tale and cast our lot with the real market of business.
But Marcus, the real market doesn't feel very real to a 25-year-old looking at a housing market where prices have decoupled from reality. You're telling them to buy a total stock market index fund and wait 40 years. In 40 years, will there even be a fair share left for the ordinary investor? Bogle calls it a positive-sum game, but it feels increasingly like the house, Wall Street, and the helpers is the only one actually getting rich.
That is precisely Bogle's point. He literally calls the investment business a giant scam by quoting Jack Meyer. The helpers, the brokers, the hedge fund managers, the financial influencers are the ones siphoning off the returns. Bogle's parable of the Got Rocks is the perfect system analysis. The family owned 100% of corporate America and got 100% of the rewards until they started hiring helpers to outsmart each other. As soon as they started trading, their share of the pie began to shrink because of commissions and taxes. Simplicity isn't just a lifestyle choice. It's a defensive strategy against a predatory system.
Predatory system. You're sounding like a revolutionary, Marcus. But let's talk about the cost of that simplicity. Bogle is obsessed with the relentless rules of humble arithmetic. He says if the market returns 10% and you pay 2.5% in fees, you've lost a huge chunk of your potential wealth. I get it. But what about the cost of opportunity? In the age of AI investing, some funds are using machine learning to identify inefficiencies that a passive index fund will never see. Why should I settle for average when the average might not be enough to retire on anymore?
Because average is a lie. In the world of investing, average before costs is the market return, but after costs, average is actually superior. Bogle shows that the S&P 500 index has outpaced the average actively managed fund in 26 of the last 35 years. If you settle for the market return, you're actually outperforming something like 90% of the pros over the long term. The system is rigged so that the more you try to beat it, the more you lose to the croupiers.
Okay, let's talk about those croupiers. You mentioned Bogle's disdain for trading, but what about ETFs? They are the darlings of the modern FIRE movement, financial independence, retire early. People love them because they're low cost, like index funds, but you can trade them in real time. Bogle, however, seemed to think they were a traitor to the cause.
Oh, he didn't just think it. He practically shouted it. He called the ETF a wolf in sheep's clothing. He loved the original idea of a broad market index, but he hated that people were using them for short-term speculation. He compared the ETF to a Purdy shotgun, great for hunting, but also excellent for suicide. To Bogle, investing is owning a business forever. Trading is just gambling with a more expensive suit. When you trade an ETF all day long in real time, you're just feeding the brokers and the tax man.
But that's where Bogle feels out of step with the psychology of 2024. We live in an instant gratification world. Financial influencers on social media aren't posting about the majesty of simplicity. They're posting screenshots of 1,000% gains on crypto or options. The psychology of waiting that Bogle preaches feels like asking someone to watch grass grow while their neighbors are at a rave. How does a common-sense investor stay patient when volatility is the new normal?
By realizing that the rave is usually a hallucination, Sarah. Bogle admits that reversion to the mean is a law of nature. The stars of the mutual fund world are almost always just comets that flame out. He points out that of the 355 equity funds that started in 1970, only 3, that's 0.8%, actually survived and consistently beat the market over 35 years. Betting your retirement on finding those 3 needles in the haystack is a glitchy strategy. Just buy the haystack.
Buy the haystack. It's a great line. But Marcus, let's look at the inequality problem. Bogle argues that consistency matters more than brilliance, but consistency requires disposable income. Inflation and rising living costs are devastating the returns of the average investor. If you're starting with almost nothing, fair share of a 7% return doesn't get you a house. It barely gets you a week's groceries in 40 years. Isn't Sarah right to be skeptical that Bogle's win-win capitalism still works for the person at the bottom of the food chain?
I won't lie, the math is harder now. Bogle himself warned that we're facing an era of subdued returns. He projected that instead of the historical 10%, we might be looking at 7% nominal returns, or even less after inflation. But Sarah, if the returns are lower, that makes Bogle's common sense more important, not less. If you're only earning 7%, you can't afford to give 2% to a fund manager. That 2% fee isn't just a fee anymore, it's 30% of your total profit. In a low-return world, cost control is the only lever the ordinary investor can actually pull.
You're very good at this, Marcus. But what about the entertainment factor? Social media has turned investing into a hobby, a community, a form of identity. People want to play around with their money. Even Charles Schwab admitted it's human nature to try to pick the right horse. Bogle says we should be defensive and unimaginative. Is it really a common-sense strategy if it's so boring that people lose interest and stop doing it?
Bogle has a solution for that. He suggests a funny money account. Put 95% of your wealth in your serious money index funds and take the remaining 5% to gamble on individual stocks, crypto, whatever makes you feel alive. He bets that after 5 or 10 years, your serious money will win in a landslide, and you'll realize that the thrill of the chase was just an expensive distraction.
Okay, but here's my final skeptical strike. AI. If AI starts managing the entire market, making millions of trades a second, doesn't that change the efficiency Bogle relies on? If the pros are now super intelligent machines, can the know-nothing index investor really expect a fair share? Or will the AI find ways to front-run the index funds until the haystack is just leftovers?
That's a fair question. But remember Bogle's humble arithmetic. No matter how smart the AI is, the total return of all investors combined must still equal the market return. If the AI winners get more, someone else has to get less. And the AI isn't free. It requires massive energy, data, and genius programmers. Those are all intermediation costs. The index fund still wins because it has the lowest overhead in the entire ecosystem. It's the most efficient algorithm ever written. Own everything, do nothing, pay nothing.
Own everything, do nothing, pay nothing. It's almost poetic, like a financial zen. But it requires a level of psychological discipline that feels almost superhuman in our current culture. We are bombarded with fear of missing out. Bogle tells us to stay the course, but the course feels like it's being hit by a hurricane.
That's why Bogle calls it common sense. It's not about being a genius, it's about not being a fool. It's about realizing that Mr. Market is a manic depressive who offers you silly prices every day, and your only job is to ignore him. Bogle's philosophy is a shield against our own emotions, greed when things are up, and fear when things are down. He literally says, the greatest enemies of the equity investor are expenses and emotions.
So, in your view, the little book is a timeless blueprint, and my skepticism is just emotional noise?
Not noise, Sarah, calibration. Your skepticism is what keeps the system honest. But Bogle's math is irrefutable. Whether it's 1975 or 2025, the person who pays the least and waits the longest is going to end up with the biggest slice of the pie. It's the majesty of simplicity.
I'll give you this, Marcus. In a world of complex scams and 24/7 financial chaos, there is something deeply radical about Bogle's boring strategy. It's almost a form of rebellion to say, I'm not playing your game. I'm just going to own the whole thing and go for a walk.
Exactly! It's the ultimate power move. You stop being a customer of the financial industry and you start being an owner of corporate America. You fire the helpers. You stop contributing to the $400 billion a year that investors pay the croupiers. You just take your fair share and live your life.
Fire the helpers. I think that's something even a skeptic like me can get behind. Though I'm still keeping my 5% funny money for some crypto, just in case the system glitches in my favor.
Bogle would approve. Just don't forget the relentless rules of humble arithmetic. Arithmetic, as he says, is the first of the sciences and the mother of safety.
Fine. I'll sharpen my pencil and do the math. But if my boring portfolio doesn't make me a got rocks in 30 years, I'm coming for your firmware, Marcus.
Stay the course, Sarah. The system doesn't glitch when you own the whole thing.
Thank you for listening to this discussion on the System Read podcast. If you enjoyed this episode, please hit the like button and subscribe to ensure you don't miss our upcoming deep dives.